Welcome to Crypto Tour, where we provide tips and insights on investing in cryptocurrencies. In this video, we'll explore 8 important things to know about crypto taxes, including how they could impact your profits. Stay tuned to the end for more tips on maximizing your crypto profits. 8 important things to know about crypto taxes. 1. You'll be asked whether you own or used cryptocurrency. Your tax return requires you to state whether you transacted in cryptocurrency. In a clear place near the top, Form 1040 asks whether taxpayers received, sold, sent, exchanged, gifted, or otherwise disposed of a digital asset at any time in the tax year. So you're on the hook to answer definitively whether you transacted in cryptocurrency, putting you in a position to potentially lie to the IRS. If you don't answer honestly, you could be in further legal jeopardy, and the IRS does not look kindly on liars and tax cheats. 2. You don't escape being taxed just because you didn't get a 1099 with a bank or brokerage. You and the IRS will typically get a Form 1099 reporting the income you received during the year. That may not be the case with cryptocurrency, however. There isn't really the same level of reporting yet for cryptocurrency relative to typical 1099 forms for stocks, interest, and other payments. The IRS doesn't get great reporting from Coinbase and other exchanges. However, a November 2021 law was supposed to require greater tax reporting for those in the industry starting on January 1, 2023. The law requires brokers, including controversially, anyone who moves digital assets for another, to report that info to the IRS on a 1099 or similar form. Opponents say the law would require anyone who moves cryptocurrency, including miners and crypto wallets, to follow the new rules, including those who have no access to that info. So lawmakers have delayed the implementation of the rule as they work to more narrowly define who it applies to. But the lack of a 1099 won't let you escape any tax liability, and you'll still have to report your gains and pay tax on them. Still, it's not all bad news. If you had to take a capital loss, you could deduct that on your return and reduce your taxable income. 3. Just using crypto exposes you to potential tax liability. You might think that if you only use, but not trade, cryptocurrency, you're not liable for taxes. Not true. Anytime you exchange virtual currency for real currency, goods, or services, you may create a tax liability. You'll create a liability if the price you realize for your cryptocurrency, the value of the good or real currency you receive, is greater than your cost basis in the cryptocurrency. So if you get more value than you put into the cryptocurrency, you've got yourself a tax liability. Of course, you could just as well have a tax loss if the value of goods, services, or real currency is below your cost basis in the cryptocurrency. In either case, you'll have to know your cost basis to make the calculation. It's important to note that this is not a transaction tax, it's a capital gains tax, a tax on the realized change in value of the cryptocurrency. And like stock that you buy and hold, if you don't exchange the cryptocurrency for something else, you haven't realized a gain or loss. 4. Gains on crypto trading are treated like regular capital gains, so you've realized a gain on a profitable trade or purchase. The IRS generally treats gains on cryptocurrency the same way it treats any kind of capital gain. That is, you'll pay ordinary tax rates on short-term capital gains up to 37% in 2023, depending on your income, for assets held less than a year. But for assets held longer than a year, you'll pay long-term capital gains tax, likely at a lower rate, 0, 15, and 20%. And the same rules for netting capital gains and losses against each other also applies to cryptocurrencies. So you can deduct capital losses and realize a net loss of up to $3,000 each year. If your net losses exceed this amount, you'll have to carry them over to the next year. 5. Crypto miners may be treated differently from others. Do you mine cryptocurrency as a business? Then you might be able to deduct your expenses as a typical business would. Your revenue is the value of what you produce. If you mine cryptocurrency, you realize income at the fair market value. So that's your basis in the cryptocurrency, says Harris. If this is a trade or business, your expenses may be deductible. But that last bit is the key point. You have to be running a trade or business to qualify. You can't operate your mining rig as a hobby and enjoy the same deductions as an actual business. 6. A gift of crypto is treated the same as other gifts. If you've given cryptocurrency to someone, perhaps a younger relative, as a way to spark interest, your gift will be treated the same way as any similar gift would be. So it can be subject to the gift tax if it's over $17,000 in 2023. And if it comes time for the recipient to sell the gift, the cost basis remains the same as the giver's cost basis. That said, there are some ways to escape the gift tax, even if you go over the annual threshold, such as taking advantage of the lifetime exemption. 7. Inherited cryptocurrency is treated like other inherited assets. Inherited cryptocurrency is treated like other capital assets that are passed from one generation to another. They may be subject to estate taxes if the estate exceeds certain thresholds, $12.92 million in 2023. Like stock, Cryptocurrency enjoys a stepped-up cost basis to the fair value on the day of death. So generally, cryptocurrency is treated for most people like a typical capital asset, says Harris. 8. The wash sale rule does not apply to cryptocurrency. While the IRS treats cryptocurrency mostly as it does capital assets, it takes a totally different approach when it comes to wash sales. And that's actually beneficial for crypto traders. Normally, when a trader sells an asset and declares a loss, the trader must not have purchased the asset or a very similar one within 30 days before or after the sale. If the trader repurchases the asset within that 30-day window, it's declared a wash sale. So the loss can be claimed as a write-off until the trader refrains from purchasing the asset within at least the 30-day window. But the wash sale rule does not exist for cryptocurrency. So traders can sell their position, book a loss, and then literally repurchase the asset moments later and still be able to claim the loss. That rule is advantageous because it allows traders to capture the full value of the tax loss while still being invested effectively, meaning it's riskless to actually avail yourself of the tax write-off. But legislators have been discussing closing this loophole, so it may not exist much longer. It can be surprisingly onerous to actually use cryptocurrencies, from tracking your cost basis, noting your effective realized price, and then potentially owing tax even without an official Form 1099 statement. Plus, the IRS is stepping up enforcement and surveillance on potential tax evasion by looking more closely at who's exchanging cryptocurrencies. All these factors help make cryptocurrencies more difficult to use and likely stymie their broader rollout. That concludes our look at 8 important things to know about crypto taxes. By understanding the tax implications of your crypto investments, you can make more informed decisions and potentially maximize your profits. If you're interested in learning more about investing in cryptocurrencies, be sure to check out our channel, Crypto Tour, for more tips and insights. Thanks for watching.